thing is the market's changing quite quickly. I do work with RIA a lot. Our impact fund's RIA certified, but the research for RIA is really helpful for those people who want to consult it. It's laid out in a really clear, distilled way. But Australian responsible investment market, I think reached a peak number in 2023, waiting for last year's figures. But nearly 300 investment managers are now engaged in responsible investment. So about 93% of all professionally managed assets in Australia are engaging in some way. And it was 57% the previous year.
We've got some fresh new young talent doing some things that I know you haven't heard before.
1, 2, 3, listen.
Welcome to Finances, your home for all things financial, investment, money and lifestyle. Hosted and curated by the very talented team of certified financial planners at Burke Britain Financial Partners.
Welcome to another episode of the Finances podcast. A little bit different today. I haven't got my co-host Jay Burke with me, so just me, Ben Kemp, one of the senior advisors here at Burke Britain, who will be running this one. Fortunately, I've got a guest who apparently is very good at talking and is going to cover me pretty well. So I've got Caroline Ramscar from Rowe Price, ESG investment specialist for the APAC region. So before I hand over to her and get her to tell us all about what she does and why it's so exciting, a few headlines that we'll try and cover off today. So probably some basic stuff, and then we'll try and layer it up a little bit. But a lot of people still ask, what is ESG investing and what forms of that do exist. So we'll go through a little bit of some general information. And then there's been obviously a lot of research showing that there's more interest from the Gen Y, Gen Z sort of demographic trying to get into this space. So we'll unpack that a little bit. People are always worried about returns, and if I start to filter out investments, is that go and have an impact? So we might cover a little bit of that, and just some more trends broadly. Obviously, government incentives and spending probably putting some tailwinds behind some areas of the market. So again, I'll let the expert tell you all about that. So welcome, Caroline, and thank you for coming on.
Hi there. Thank you very much for having me.
It's now again, before we deep dive into the tech stuff, let's hear a little bit more about you. So how long have you actually been in Australia? Is it only one and a half years? Is that correct?
Yeah, I actually just passed my 2-year milestone the other month. So yeah, it's been a very interesting 2 years. I arrived at a really good time, particularly for the field I'm in.
Yeah, and I think you said you wanted to try living in Australia, is what you'd said somewhere. So how's that going? You survived 2 years, so it can't be going too badly.
I've survived 2 years, and especially the heat. No, it's been fantastic, and I've been very lucky. I've just arrived at a really good time, particularly for the industry and the things I'm interested in. So I couldn't have timed it better.
Perfect. And I think, again, going back through sort of your story, give us a little bit around where you grew up, and I think maybe a couple of things around why you probably from a young age have sort of had sort of a tilt towards this sort of style of investing. Is that correct?
Yeah, I think it's very much to do with the fact that my parents were in the civil service, and that concept of always giving something back and what you're contributing to society was drummed in quite early on. The other important piece is I came from Manchester, and I went to an all-girls school there. And it was very much a school founded in the 1890s by some, I'd say, very far-sighted families and mill owners, particularly, who wanted to educate their daughters in the same way that their sons had access to education. So I think just having that background and knowing that you could be part of that change and make a difference was important early on. I did take a very traditional route in banking, like a lot of people have done. Worked in investments for a very long time, but I always was involved in the philanthropy, and it was very much on the side back in the day. Whereas once this way of investing, responsible investing, started to gain traction, the ability to combine both was really interesting. And I would honestly say it's helped elongate or keep me in the industry and for all the many years to come, now that you actually can combine this type of investing and really making an impact in the broader sense.
Awesome. And I think, again, did you have to find that it was difficult sometimes working in areas where it maybe wasn't you weren't as passionate about the investing? Like, is that what you mean by that? And you weren't always able to express what you actually had the passion for because of the way the industry was set up, but it's now sort of maybe hitting that sweet spot for you now?
That's an excellent question. I've not been asked it in that way. I was always interested in what I was doing. I'm probably one of those people who wouldn't be doing my job otherwise. And so all the jobs I did before, I was always interested in. And it's very much about clients. I've always worked with clients. And that's the biggest thing, that connection and being part of something bigger and wider was always very appealing. But these types of roles weren't mainstream, and the type of investment wasn't yet mainstream, particularly in the UK back in the day. It was very much sort of socially responsible investing and to the side. Whereas once I say the industry, market demand, regulation, and just a better understanding of how some of these attributes play out in portfolios started to take effect, then you needed roles and experts who could go and talk to clients about their mandates.
Awesome. And I suppose maybe on that, like, for those that see it thrown around, what is ESG to you, or what do you think it should be to people? And it's probably a lot of things bundled in under that banner, isn't it? So like, what would you say it is? What is social investing?
Yeah, bundled is a great word to use. So ESG, environmental, social, and governance, I always like to say it's missing a word because it's an acronym, but it's missing its ESG integration or ESG considerations or ESG data in the investment process. And it's very much about the incorporation of environmental, social, governance factors into the investment analysis. So honestly, any asset manager as standard should be thinking about these things now. So it's very much almost the sort of hygiene factor or the sort of the entry level way of considering a ESG integrated in the investment process to lead to a better outcome through better investment analysis. So inputs. When people talk about responsible investing, sustainable investing, all these things, and then coming on to impact, a lot of the time there's a lack of clarity around the definitions. It does get bundled, or I'm northern, like to say lumped in together. But really sustainable investing is further up that, I'd say, that green bar, if you like to think. And that's where it starts to become more values-based when you start talking about sustainable investing. And alongside a financial return, the clients expressed that they want to promote either an environmental, social viewpoint or objective. And it's very much coming from the client as well at this stage. And that's further up that impact journey. And then right at the end, you've got impact, which is much more explicit. It's the definition of impact investing is the one where it matters so much more about that measurability and that evidence that you're investing made with the explicit impact of generating a positive environmental or social impact alongside a financial return. So very much the dual mandate territory.
I think historically, and this is probably, and maybe I'm not correct here, but how it's been viewed is there was like a filter out process. So it was sort of like initially it was just go through and not invest in things that didn't fit people's objectives or personal preferences. Whereas the way that's evolved now is that you're actually looking at, okay, investing in areas to be proactive and looking at what's next and solutions based investing. Is that correct?
Yeah, that's a really good way of looking at it. So with sort of that middle bucket, sustainable investing, that is a very broad church of definition and screening and exclusionary, and what's out was very much part of that. But as these types of I'd say capabilities have evolved, particularly with impact, it's actually about what's included and that really sort of deep bottom-up analysis of that forward-looking projection of the company from a financial thesis perspective over a certain time period, could be like a 5-year plus time period, how we think the company's going to perform, and also a really high bar for inclusion in the portfolio. A lot of the time, the number of stocks can be relatively small, could be like between like 35, 60 type portfolios, because it really is about very detailed bottom-up analysis.
Do you think that there is, maybe jumping sideways a little bit here, but there's some product providers and investors out there that are providing, sort of a half-baked sort of, I don't know what you said, maybe greenwashed version of these products as well? Is that sort of, because it has become a bit of a marketing piece for some, do you think there's some genuine ESG investing, and there's some that's not completely genuine?
Look, it's hard to say about what's genuine. I think if I view it as there's probably a lack of clarity and transparency
Yep.
from some providers, or if I flip it the other way around, from like a mum and dad investor or someone looking to come to a financial advisor for advice. It's probably very difficult to cut through what's actually going on. And there's lots of different terminology. Some of it's jargon, lack of support, education at times, and it's just not always clear. With some funds, I'd say what's going on under the bonnet. I believe the regulator in Australia will be sorting that out and has already made strides in that direction, and very much signaled the intent from a regulatory perspective will be to help support end investors, which to me in the industry is only a good thing. That clarity, that transparency. The Australian government, current government, and the sustainable finance plan and the direction of travel there is very supportive, where things like labelling could come through underpinned by disclosures, clearer disclosures. And what that really means is when people who aren't as familiar with these types of funds, products, terms come to select their investments or work with their advisor on that, it'd be much clearer labelled what that fund represents, and also a lot more information disclosed underneath that.
Awesome. With maybe tying it back to Rowe Price, like where are you finding the most uplift or the most interest is for you guys from a funds perspective, or questions and themes that people are coming to you with? Is there anything specific they're looking to try and invest with impact or filter out as well? What are the main sort of themes for you guys at the moment?
I think there's definitely certain themes that in Australia which resonate. We're particularly seeing lots of questions around sort of holdings and sort of how we actually measure out that impact, what types of investments we have, and particularly around like oil, gas, decarbonisation, and very much around solutions of the future. So not just excluding oil and gas, but is there anything a bit more interesting? One interesting area as well is healthcare. So the GLP-1s and the drugs that are being developed. One of our holdings, Eli Lilly, has made great strides in that regard, and all the impact that's had on extending patients' lives through tackling diabetes and the health implications on longevity. So I'd say healthcare has been particularly a more interesting one. And there's a couple of things around banking as well that are quite interesting from a financial inclusion perspective. So when people come and talk to advisors about their investments, people often want to feel good about their investments. So we use the SDGs through our impact fund. For example, every stock is aligned to at least one SDG. And one of our holdings, New Bank, which was launched in Brazil but is extending out across Latin America, is about financial inclusion. They have, I believe it's 75 million debit and credit cards now issued to people who otherwise wouldn't have had access to this type of financing. And there's also a really strong financial thesis behind this company as well. So I think a lot of the time when people are talking to us, it's beyond just, I say, decarbonisation, which is very, very important and was originally the first starting point. It's also about what other types of impact you can have, particularly around the S.
I was going to say, I think that most people, again, that they're thinking more around oil, gas. Like that's just the really simple view of that stuff. They're not going out into those other layers. And it's interesting to hear. And again, you probably touched on one there from maybe on that sort of energy sector. Like, how do you invest in that with impact? Like, what would be? Do you have any good examples of a company or a thematic or something they're following that's got that positive impact?
Yeah, absolutely. There's a really good company. It's quite, I say it's fairly well known, but it wouldn't be as maybe well known for the impact thesis. It's called Linde. So it's one of the largest industrial gas companies. In fact, it probably is, I think, the largest industrial gas company globally. So it's a really high quality, durable asset, and it's got a really attractive opportunity tied to decarbonisation. So it's got a very good sort of future ahead of it, because we have these holdings at least for a couple of years. So we have to identify the pressure point that we're helping to solve for inclusion in an impact fund. So decarbonisation of heavy industries with the help of the technologies will be key to achieving the Paris Agreement goal. But with our impact funds, we also want to make sure that there's a strong financial thesis there. So Lindy is pretty innovative in how it helps customers reducing their carbon footprint. So it provides a lot of solutions. So it's very much one of those sort of solution providers, not just about excluding oil and gas companies, but looking at those that are helping to solve for future. So it's a huge enabler of green hydrogen, carbon capture, storage, all these great technologies that others can benefit from as well. So it ticks off the SDGs, affordable clean energy, and it's also got this strong financial thesis as well.
Just on the STGs, can you just break that down just so people understand exactly what you mean by when you say STGs?
So the Sustainable Development Goals, that's a really good point. They are not, some markets are more familiar and they're heavily embraced by Japanese clients, but there's something that we find in Australia, the Sustainable Development Goals, which were originally developed by the UN to help sort of focus, I'd say, countries on the challenges ahead and where they really need to be focusing their programs or investments. And they've been adopted by the finance industry. So these Sustainable Development Goals, of which the 17, help target things such as health, climate, energy, good health and well-being, for example, is one of them. And it really helps, I'd say, give a North Star to people when they're having discussions, either with clients. We find advisors and clients use them as a good cut through to what's going on in the portfolio. And we also have the Sustainable Development Goals in our impact fund, signaling which holdings, which SDGs they have met. And we also have this on our website. We've got a new impact tool. And in fact, the SDG part of the impact tool is probably the bit that's had the most hits since it was launched a month ago. So in short, there's something that was backed by the United Nations, set up back in the day for countries to help focus and everyone align behind certain problems that need unblocking globally, but have embraced by finance investors as a way of targeting their own capital and investments more directly.
Perfect. I think people understanding the layers of framework that go behind it, like it's not just lining up, I don't know, 100 different companies and just sort of, filtering a few out and tilting towards a few. The layers of process and analysis that goes into meeting all these things is really high. And I think that's where, you talk about being invested in something that has oil or gas, in connection to it. Immediately from a layman maybe just thinks that that's impossible. But if you understand that backing to it and the process and their strategic approach, then those things aren't just tossed out. Like, some obviously will be, but if they're doing the right things and angling in the right direction, then anything can really meet those potential needs.
Yeah, I think it's back to the point that when you're asking about some of the funds already out there, I think it's really important. It's about the implementation. It's got to be a robust implementation. And we see those in the industry. And the more that there are, the better choice there will be for clients. And so the robust implementation, which means the investment process got to be really tight around what's included. Back to your earlier point about exclusions, it's also about the inclusions. There are some core exclusions based on those sort of the worst of the worst companies, but it's about really what makes up then the rest of the portfolio and looking at, does it have a KPI? Is it aligned to an SDG? Can you measure the key performance indicator? Can you evidence that there's intentionality around that positive societal or environmental outcome? And not all stocks have that. And if they don't have that, they won't make it into an impact fund or shouldn't.
Perfect. Yeah. Again, it's awesome for people to hear that, how this happens, like how you go through this process. With the growth in this space, and again, a little bit of information from recent conference and some reading, are you finding this push has come from the younger generations, like the Ys and the Zs? Is that what you think is real, or is that the reality, or is that just a bit of a conversation point and the general sort of thing? What do you think on your side?
I definitely think that's something that's in flight and also coming. We're starting to see advisors reach out for education needs, particularly around how they have the conversation. So I think to frame that, there's a very honest recognition in the industry that this is a real thing, particularly with the intergenerational wealth transfer. And the RIA did an excellent values to riches study last year. I think they do it every 2 years. And there were some really pointed stats in there. They surveyed quite a lot of people, and just looking at the fact that this is a really powerful validation from the industry of the fact that people want their investments to align with their values. And they're starting to, particularly the 25 to 39-year-olds, fed back 84% would consider moving to another provider if they found out their current fund was not consistent with their values. So the proof points are there, and we know that it's coming. I would say it's still some early days for has that scaled up through advisors and seeing the demand. But from what I've heard from the advisor community, there's questions being asked where advisors probably need upskilling and the tools and support from the asset management to have industry to have those conversations. So it's definitely starting.
Definitely. And I think historically, again, just speaking from my experience, is that it was rarely raised. Like, it rarely got raised. It would be, once every few months, someone would ask or mention it. So being much more frequent now. Then, you sort of go through that process. A lot of the people who are raising it, not necessarily the ones with big amounts of asset to be investing as well. Like, they've got the interest, but they might not actually have the actual asset behind them to be pushing a lot of funds through into that space. Maybe through their superannuation, they're getting higher levels of contribution that they have in the past, which they have a preference around investing. But, a lot of them in that bracket you mentioned, they're trying to save to buy a home or save or just survive in many cases where their cash flow has been hit from rising interest rates and things. So they haven't necessarily got the free cash flow to be plowing a heap of money in, even if they want to. They're trying, but they haven't necessarily got that cash flow asset backing behind them, which again ties into your point around that wealth, the intergenerational wealth transfer, which is obviously heating up quickly. When these lump sums start to roll through, you're going to see a change in how they get deployed pretty quickly, aren't we?
Yeah, and I think another good proof point, because a lot of these types of conversations traditionally were on the institutional side globally, and then played out through sort of the advisory, intermediary wealth market. And we're absolutely seeing, particularly in Australia with my role, I speak to all different client types. I actually have an APAC role, across Asia role, but spend a lot of my time based in Australia and speak to Australian clients, and particularly super funds, and particularly certain types of super funds, where there's industry super funds as well, will have a really vocal member base. So we're seeing our super fund clients really go deep on this because they have a vocal member base who'll be raising lots of questions on their behalf. And also, what types of options, solutions do we have to help meet this sort of shift in how members will want to see their investments managed? So that's definitely happening in Australia, and it will definitely filter through. It's the same types of investors, just they're investing via their super rather than their private investments. And the other thing is the market's changing quite quickly. I do work with RIA a lot. Our impact fund's RIA certified, but the research for RIA is really helpful for those people who want to consult it. It's laid out in a really clear, distilled way. But Australian responsible investment market, I think reached a peak number in 2023, waiting for last year's figures. But nearly 300 investment managers are now engaged in responsible investment. So about 93% of all professionally managed assets in Australia are engaging in some way. And it was 57% the previous year. So already we're seeing those year-on-year increases across the industry.
Is that reflective of, and from your background working obviously not specifically in Australia, are we lagging on that data? Are we aligned to it? Are we ahead of the curve? Is everyone sort of in the same boat globally? What do you see?
Starting to see, so this really was very much led by European investors. There was definitely pockets of other asset owners or firms in other regions, but Europe really have sort of culturally embraced this type of investing for a long time. And the UK came up the curve. Regulation definitely helped on the institutional side and also on with the advisory market. But it's not just regulation. You can't just achieve it by regulation. It helps. It's also in market demand. So there's a growing sort of awareness and shift of the value of people's investments and private capital to help solve some of these global issues. When I arrived in Australia, as I alluded to at the beginning, it was a really good time to have moved here, particularly with the direction of travel from the government and people really starting to think about these considerations in their investments. And I think there was a quote I read somewhere that Australia had gone from laggard to early follower with this sustainable finance plan that was put out. So I think Australia's absolutely up there. We see our New Zealand client base and just with what the New Zealand government's been trying to achieve, really be pushing things on the climate front. But Australia's definitely in the pack, leading the conversation. And with an APAC role as well, I often refer back to Australia and New Zealand when I'm talking to clients in other countries. So you should be very proud of the progress.
Sometimes we're a bit slow to move, so I was just wondering how we were going down here. With you mentioned a few times the term government, and I think how much does government intervention, incentive spending, and sort of who maybe who is in power impacts the sector and impact the desire for people to move into that space? Is it the biggest? Is it one of the biggest factors?
Well, I'd say it's helpful. So I suppose it's back to what I alluded to before in the UK. Regulation is certainly helpful, but it's got to be investor-led as well. But market demand's got to be there. That's really the most powerful proof point ahead of regulation, and then when regulation comes in to really embrace and get behind it. So I think what the Australian government's been doing and their direction of travel has been helpful because it helps signal where this is going, and it also means that people start the conversations. For example, been working with peers and other asset owners or other advisory firms or people in the industry around what labeling could look like. Those conversations have started because of that direction of travel has been signaled, and especially looking at what other countries have done so that we keep it really simple. So it's been helpful. I think the government and all of the plans that it's put out there, it's been really clear, transparent, lots of education support behind it has been helpful. And also the greenwashing regulation that they have put in place as well. I think that's been something that's probably shifted the conversation as well, because it's really pushed people to start asking the right questions. There was a bit of a focus on obviously not wanting to be penalised from an asset manager's perspective, but that pressure is good pressure because you're actually protecting the industry. So that was all helpful. But the question on governments changing, I mean, just globally, we see this. Is this something that we'll see rowed back or change? Well, the way we often like to think about it, particularly where we have underlying companies as well, a lot of these plans and decision making is already in progress. A lot of the spend's already in progress. So I'd like to think that these types of initiatives are continuing, regardless of government. It's just you do need a supportive government for people to really feel comfortable and ride through that uncertainty. But the interest, the support, the disclosures, all the things that have been put in place, some mandatory climate disclosures are already live in Australia. That's sort of those sort of practices are not going to be unwound. So it's going to be really interesting to see what does happen as governments change or not, but it's really about the market demand and supporting that. And I think we've all got a role to play in that. That's probably the purpose of this podcast, with support, education, helping people understand, helping cut through what's going on with their investments, and just providing them options and choice amongst all of this jargon, probably complexity.
Yeah, I was going to say I scribbled down a few different, all the different acronyms and jargon and things that we use all the time. And one of those terms, and again, we both of us are around this all the time, but even the term greenwashing, I used it earlier myself, and then you used it again. Like, greenwashing, essentially, I'll let you can answer this question more than me, but essentially people trying to, funds giving a perception that they're something they're not, in a green sense, in terms of being ESG aligned. Is that the really simple term? How would you describe greenwashing?
Yeah, it's essentially just you've given, I'd say, false impression that it's either a company or a product, like a fund, is more environmentally friendly than it actually is. So it's basically just latching on to some of these claims and credentials, but actually it's false or misleading. So as much as any other regulation is in place to not be misleading to underlying investors, this one specifically is targeting the environmental claims around a product or service.
Perfect. One of the questions that always flows off the back of this is balancing up, returns with like having a personal preference, and how does, having an overlay of personal preference impact the potential for negative returns or improved returns. Some people would argue it's the way to go, is to get better outcomes from their portfolios, is to invest in things that are looking longer term with sustainability about them. You're probably a biased person to ask on that question, but is that what you're feeling, is that you're not losing anything from a return perspective by approaching it in this manner? And again, there's probably data there that suggests that as well, I assume.
Yeah, so I really try not to be biased in that, because it's not a values-based judgment of my side as an asset manager. It's clients that come to us, and it's very client-led, that they want to express a particular view, and they'll often come to their advisor and have a particular focus or theme in mind, which is where, back to the sustainable development goals, they're helpful for advisors to help sort of target the conversation, have a better conversation. But it'll be client-led around wanting financial return plus that sort of measurable environmental, social contribution. So we as asset managers and providers want to make sure that people have choice and that you have the best implementation possible. And it's great if other people do the same, because then there's even more choice and sort of competition in the industry around making sure that you do still get your financial returns. Clients still want financial returns. We want better outcomes for people over the longer term, whether that's retirement or just savings, your super fund. So that return element is still so fundamental. But in these dual mandates, the client has opted for something alongside that. So for mainstream solutions, you need to be able to deliver both. What we believe with the approach we take with the Impact Fund is we've selected companies that have gone through a very rigorous process to make it into the fund, that really have the ability over the longer term to outperform, or there's something there that we've unearthed. I mean, we operate in 17 markets. We have hundreds of analysts to draw from. We have dedicated research analysts on the responsible investing side. And we have an impact team dedicated to looking at these stocks. So it's really finding something that's a little bit different, that's unearthed, that may not be appreciated, you may not be able to find yourself, and making sure that that financial thesis is robust in the longer term as well.
I think historically people have looked at it differently. We've had clients come in and they've said like they have an interest in investing in property or shares, as an example. Like they might have a bias towards one or the other, and you might work through a process to work out what suits their needs better. But they might have an underlying preference for one over the other, and then you need to work out how that best works for them. In a way, for me, that's sort of how, if someone comes in and they said, look, I have these personal preferences and I want to invest in this manner, then you filter down and go, okay, well, here's the offerings available from these funds that we have listed. Is that again how you would sort of view it? It's more about the goals and preferences, and then working through, okay, well, here's my range of options to invest with that in mind.
Correct. And so it's really fundamental then the role the advisor plays in that conversation. And again, from an asset manager perspective, we have tools on our website for advisors. There's a lot of education. We're more than happy to come in and help support advisors in those conversations. But just putting that content out there, we have an annual impact report. We have a tool for advisors to engage with that really breaks down all these, I think, could be quite complex terms we've been talking about, to really what's going on in the portfolio and the holdings. So you can hover above the different parts of the holdings, and they'll give you examples, case studies, the investment thesis behind it. We also have a tool which means the advisor can then pass this on to retail clients, and it takes them to a different retail website where it's all complied for end investors. So it's about helping advisors bridge that knowledge gap as well, and be furnished with the right information so that you're better equipped when the clients come to talk to you.
Perfect. And again, I'll make mention of it. Any of obviously these education things, we'll make sure all of those links get put into the show notes so people can click through and read that themselves, and then you know where to come for questions off the back of that. So no doubt we'll get a few people looking and just considering. I think that's the other thing, is just being completely transparent, putting it on the table. Probably some of the traditional scope of the industry, from a financial advisor perspective, it hasn't even been bringing those options onto the table. Like, it's probably been quite sort of surface level, but now it's about investing, not just investing for returns, but investing how people want to invest for their own personal preference and comforts, as well as not forgetting what their goals are. Ultimately, no one's going to do, no one goes to work for free. And if they love their job, there's always got to be some financial, consideration that applies to it. Anything we haven't sort of talked about today that you think is really topical in your space at the moment, or anything you want to make sure people are aware of and are keeping an eye on?
I think one of the things I'd just like to say is thank you for the opportunity to talk around this. I think you've a really good handle on the place for responsible investing, in whether that's impact or just looking at different types of ways of expressing how people can align their investments with their own values. And people do want to feel good about their investments. We find that we get a lot of engagement. For example, 160 advisors already have been on our impact tool looking at the sustainable development goals of the portfolio. That's a great stat already. We weren't sure whether people resonated with this type of information. So it's clear that there's a need out there, and there's interest and engagement. And I think it's really just the start. So it's great to have this opportunity, and more than happy to help support these conversations where people need to. The other good thing, you can have a much more interesting conversation as well. Obviously, returns performance key, but also just some of the interesting informations and looking globally at these issues and how we can help private capital to solve some of the bigger issues. But also, I was talking to some of my colleagues the other day. There's a lot of fun facts that you find out around these holdings. So we hold one company, MSA Safety, who is a market leader in fire safety equipment. So it's got a really strong investment thesis. People always need safety products. There's a recurring need there. But one of the pressure points that we're looking to solve, 2 million people die each year in work accidents. And there's 360 million work-related injuries. So you often find that these companies are doing quite quirky things, or there's interesting facts that you wouldn't have been aware of in your day-to-day business, or where your proceeds of your investments are going. So
People love that story. They love that.
Engagement. I mean, look, we've all got a lot to look at with our supers, our savings. There's a lot of information coming our way. So if we can cut through, make it interesting, have an informed conversation, and some fun with it, that's great.
It's really interesting because I think it's almost conflicting at the moment, in the sense that people are time poor and they've got lots going on, more than probably ever before, but they actually still want to know more about what they're doing with their money as well. And that's where having tools and information, and whether that's through your platforms and through those means to find ways to get data quickly and get information, but have small purposeful little stories that they can cling onto, like understanding that quite quickly, it gives them comfort. And people are more interested in what they're investing in, even though they've got less time to maybe be actually digging in and doing it. So again, that's probably some of the reason for this podcast as well, broadly with all of the different guests, is just giving people other ways to access information to help them make decisions, and then working with people like yourself and like us to get some plans in place to not just think about it and then actually action some things and know that they're doing what they want to do, growing their wealth, doing it with peace of mind, that they're doing it in a way that they feel comfortable with as well.
Yeah, exactly. And there were some interesting stats that also came out of the RIA research the values to riches, which is a great piece of collateral to look at, that women are less likely to be happy with the information received from their investment providers. It was 59% satisfaction compared to 67% for men with the information available. And women expect more communication regarding the impact of their investments. That was about 85% versus 78% for men. So people want information from their advisors, particularly women.
And both those stats are pretty low, to be honest. Like, I think 59 and 67, both is, there's so much room for improvement on that information piece. And I think transparency, and it's probably through a lack of trust in the industry across banking and financial advising and funds management and everything over the last couple of decades, has driven people to really want to know what's happening, as well as just a general interest from a community sense to also want to know, where is my money going? So transparency has never been higher. And if you don't have anything to hide, it's not a drama. People only worry about those things if they're worried about what they've got going on behind the scenes. So, transparency, information, all those things are perfectly aligned to what we want to be about here as well.
Yeah, clear, concise, transparent information with the tools and the way of accessing this directly yourselves, ideally.
Awesome. Well, thank you for joining us. It might be interesting to get you back on in a little while and see how things are progressing. Again, I think this space is only really, like you said, sort of just starting to heat up, and we're going to see so much more interest in it. So thank you for all your information. And again, as I said earlier, we'll put all of those links through in the show notes so people can click through, send us questions, reach out to Caroline if you wish to as well. And thank you so much for coming on.
Yes, great. I am normally in an office, but working from home with my Orchids today. So yes, we great.
The much nicer backdrop than my whiteboard and door. So thank you.
Great. Thanks, Ben.
Thanks, Caroline.
We hope you enjoyed today's episode. If you're keen to understand more about how financial advice could benefit you, follow us on Instagram, Facebook, and Twitter at Burke Britton FP, or Google Burke Britton Financial Partners. Check out our client reviews, testimonials, and make a time to meet one of our certified financial planners by clicking Book Now on our website. Thanks for listening.
Any information contained in this podcast is of a general nature only. No account was taken as to the objectives, financial situation, or needs of any particular person. Therefore, before making any decision, listeners should consider the appropriateness of any information with regard to their particular objective, financial situation, needs, and seek independent advice from a licensed professional specific to their circumstances.
All right, hit it.
That translates to, don't be a moron and act on what some random person says on a podcast. Take personal responsibility, do your homework, ask questions, and speak to an actual human that knows what they're talking about before you do anything. PB Financial Solutions Proprietary Limited, trading as Burke Britton Financial Partners, are authorised representatives of AMP Financial Planning Limited, AFS, licence number 232706.